Hey guys, Sebastian here. You know that there are many people nowadays that have money sitting inside brokerage firms, and then there are millions and millions of people that have money sitting inside insurance companies and they have their accounts with them. So a lot of people ask me, what's the difference between having money at a brokerage firm and having money at an insurance company? Let's jump right in, guys. So as I mentioned in our previous video, I explained the difference between having money inside a bank account versus having money inside investment firms. You see, today what I'm going to be going over, what's the difference between having your money inside an investment firm versus having your money within an insurance company. So when you have your money inside an investment firms, as I mentioned in the previous video, you can put your money into like an IRA, a Roth IRA, a 401k, a 403b. You can have brokerage accounts. You can open up individual brokerage accounts, joint brokerage accounts, trust accounts, 529s. I mean, you can open up a ton of different investment accounts within an investment firm. Now, when you're opening up these accounts at these institutions, what many times you can invest in things like stocks, bonds, mutual funds, ETFs, currencies, options, real estate investment trusts. You can invest in a ton of different things inside those types of accounts. So again, you have all the different types of accounts, and then within those accounts, you can invest in all these different types of investments. Now, I do want you to know everything that you have here does have some form of risk. So that means that the money does go up and down depending on the form of investment that you have. Now, when it comes to insurance companies, you see, insurance companies, a lot of people don't understand or know that you could actually park some of your money with an insurance company. The only option is not a bank. The only option is not an investment firm. You could also use insurance companies to actually put your money to work. You see, insurance companies offer mainly two different forms of accounts. They offer something called annuities, which are forms of retirement accounts that many people use as they're getting close to retirement because they want to have either their money really safe, or they want some sort of guaranteed income, or they want to have some sort of fixed rate. I mean, I have an entire video that explains all the different types of annuities. Or they also want to have what's called life insurance. You see, a lot of people don't know that life insurance policies actually can be used as a way of building up cash value, meaning that you could actually be storing $5,000 a month, $10,000 a month, $1 million inside a life insurance policy as the cash value, and you could use it for anything that you want as well. So in basic terms, with an insurance company, you have annuities, and then you have different forms of life insurance policies that you could build up cash value in there. Now, there's a ton of different types of life insurance policies. You have universal life, you have index universal life, you have whole life, you have variable universal life. I mean, you have a bunch of different types of life insurance. And again, you have a bunch of different types of annuities. You can have fixed annuities, variable annuities, indexed annuities, whenever you're opening up an account through an insurance company and you're opening up an annuity. Now, I do want to mention one thing about insurance companies that a lot of people don't know. You see, insurance companies are actually one of the strongest, safest forms of you putting your money to actually work without taking the crazy levels of risk that sometimes the stock market provides.
I know your family.
So what some people do is that if they're looking to have their money grow, but they don't want to take risk and they don't want to see their account lose 20, 30, or 40%, what many people do is that they go to an insurance company because they know that insurance companies can ensure that their money does not go down in value, and they usually create some sort of contract, and they'll tell you things like, if the market goes up, you'll make a portion of it, but if the market goes down, then you won't lose any money. Those are usually called floors. So we have an entire video that breaks down the pros and cons of how those forms of accounts work. But again, there's nothing wrong with having money inside investment firms. There's the pros and cons of that, which means you can make a lot of money, but you could also take a lot of risk and lose money there. And then you have also insurance companies. You're typically not going to go and make 10, 20, 30% in a year normally in those types of accounts. Is it possible? Yes, it is. But these are the forms of accounts that people use that want to have their money safer, with less risk, even if they're only making 4, 5, maybe 6% a year, but they don't want to take risk with their money.
Hey, thanks so much for watching this video. If you want to make sure to catch every single one that we post up, make sure to click that notification bell, subscribe, comment, and share with someone else, and we'll see you in the next one.